In this video, we're going to complete the valuation of the file we began with Ericsson and talk about how to do what's called an as-is valuation. So just to pick up, what we have done is using our valuation model file that we started to work with, and I'm going to save this file, and we're going to call this my downloads model. So I have a copy. Okay, so what we've done is in the model data, we have 6 historical years of Ericsson data, and using the ratios, we have 6 historical years, which I will now unhide, of ratios, and 6 forecast years of ratios, which create 6 years of forecasted income statements, which I'll unhide historical ones, 6 years of forecasted balance sheets, which I will unhide, and more importantly, 6 years of economic statements, TFI, TII, CFI, and economic profit, both beginning of year and end of year. And then we also have the historical ROIC graph, and we have the ROIC drivers tree. So what we now want to do is, since we forecasted the cash flows in the CFI, we want to turn this into a valuation. So we're going to add a new tab, and we're going to call this the Enterprise DCF, for discounted cash flow valuation model. Make it a little bit bigger so that you can see this and continue building this yourself, because this will be part of your next assignment, is to finish off the valuation model and copy what I have so that we can actually practice and apply this to Costco, which you'll be doing yourself. So as a reusable model. So here's what we want to do. If we follow the methodology outlined in the book, we're using, again, Modigliani-Miller, we have to value the company's cash flows, specifically the operating cash flows, the operating value, and the non-operating value. So that everything fits on one page, we need to know, and I'm going to start going instead of across the columns, I'm going to go down the rows. We need to know what is the free cash flow of the firm into the future, because we're at the sum of the future cash flows. So relative reference equals, and I'll pull this off the CFI, our first forecast year is 2017, and we're going to forecast the next 5 years. Come on, Microsoft, equals previous year plus 1, going through 2021. That will be known as the defined forecast period. Year 6, which is why you always forecast n plus 1 years, is the first period of the perpetuity or continuing value period. That would be 2022. So these cash flows come from our CFI. So for the 2017 forecasted free cash flow, off of our CFI tab, we want to reference 2017 free cash flow, so that would be H12. And I'm going to make this tab a little bit bigger so it's easier to see what I'm referencing. But 2017 free cash flow H is 2017 12. For back to Enterprise DCF, 2018 free cash flow off the CFI forecast to be I12. Sorry, 2018. 2019 free cash flow off the CFI tab is J12. 2020 forecasted free cash flow off the CFI is K12. And 2021 forecasted free cash flow is L12 off of CFI. Okay. So I'll just format this just to make it easier to see down to no decimal places. All right. So what we next need to do is we need to present value these free cash flows. So I'm going to do that by adding the concept of a discount factor. So we have then the present value of the free cash flow. So the discount factor is just 1 divided by 1 plus R, and the R is going to be the WACC, which comes off our assumptions tab. So B4. Okay, and what we're going to do is I'm going to copy this down. So I want to make this an absolute reference, $B, $4. And I'm just going to copy it down. And for the second year, it's 1 plus B4 to the power of 2 squared. For the third year, 1 plus B4 to the third power, 1 plus B4 to the fourth power, and 1 plus B4 to the fifth power. Okay, so those would be the discount factors. And if I multiply the free cash flow by the discount factor, that would give me the present value. So 85.61 in 2017 at that cost of capital is 79.49. And again, just to make it a little bit easier to see, get rid of the decimal places, copy this down so that my operating value for the first 5 years is going to be the sum, say equals, not minus, the sum of those present valued free cash flows. So basically, if everything comes true in our forecast for Ericsson, it would be 28,738,000,000. Now they're actually in euros, but nonetheless euros for the first 5 years, present value to today. Now, here's the thing. The difference between a project and a company is we assume companies last forever, so we then need a continuing value for the company, which is going to be from year 6 into perpetuity. Now that is going to be the key value driver equation. So we're going to put it here in this cell, and the key value driver equation has 4 things. It has expected NOPLAT, has expected ROIC, continuing value ROIC, has our expected G, continuing value G, and it has a WACC. So what I'm going to do, so we can change this, is I'm going to put this in our assumptions tab. So rather than scattering this throughout the model, I'm going to put it all in one place, make it a little bit bigger, easier to see. Just a little bit bigger. 100%. And we already have a WACC, so I'm going to add a continuing value NOPLAT. So I can have all my assumptions coming out of this tab. I'm going to have a continuing value G, and I'm going to have a continuing value ROIC. And all of these are going to be changeable, so I'm going to make those yellow. So our continuing value NOPLAT is, from the TII, the 2022 expected NOPLAT, so M4. So again, when we forecast, we always forecast number of years in our model that are defined plus 1 additional year. That plus 1 additional year, in this case 2022, the 6th year, is the beginning of the continuing value period. So NOPLAT for 2022. Okay, and again, just getting rid of some decimal places. All right, G, we're going to start at basically, call it 2%. Over the long term, companies that are mature generally grow with their economies. And so we're going to use 2 to 3%. 2% right now is, I think, what people are expecting for Europe long term. So we can obviously change it, but we're going to say eventually think of this as the 30 to 50 year growth rate, about 2% as a starting point. And then finally, our continuing value ROIC equals, and we're going to use, in this case, for the model, end of year expected ROIC, and that is EPEOY, and we're going to go to 2022, which is the final year, and expected ROIC, you can see here, after goodwill, is M15 based on EOY ROIC. And I'll make this a percent so we can see what it is. Okay, so these are the four parts that we need for the continuing value equation. So I'm going to come here to enterprise DCF, and that's what we're going to put in as the continuing value of the free cash flow. So correct order of operations equals left paren, all working off the assumptions tab, expected NOPLAT, times left paren 1 minus, again, back to the assumptions tab, the growth divided by the continuing value ROIC, also known as RONIC, return on new incremental capital, right paren, divided by left paren, the WACC, minus the G, the continuing value G. So that would be the value into perpetuity. Now you'll notice that it's negative. And the reason why is because we have a negative spread. So obviously growth here is value destructive at this point. All right, so we're just starting the model. So here's the next thing. We need to present value this. Now, here's the thing. We're going to use the same discount factor for 2021 for 2022 continuing value. And the real reason why is that the growing perpetuity equation, which is this key value drivers, actually discounts the year 2022. And a common mistake would be to double discount that year. So since 2022 is already discounted, we're at the beginning of 2022, which is the same as the end of 2021, which is why we're using this discount factor. So when we present value that, we multiply this times the discount factor. So that's the value of the continuing value. And therefore, we get the operating value of the firm, which is the value of the first 5 years, plus the value to perpetuity, and that is the forecasted operating cash flow value of the firm. Now, operating value plus non-operating value equals enterprise value. So now we need to forecast the non-operating value. Here is where our model helps us with the rearranging that we've already done. So the non-operating items we can get off of the TFI, so I'll get them here, and we've already listed what those are. And actually what I'm going to do is just make this page a little bigger before I do the copy and pasting because this is small. Let's try this. Okay, well, I want to go bigger. Let's try this again. TFI. There we go. Okay, so over here on the left, before I do this, you can see that we've already arranged the three non-operating items: excess cash, non-operating assets, long-term investments. So here's what we're going to do. Equals, we need to value those. The non-operating assets are TFI, excess cash. Just copy and paste down. Non-operating assets less non-operating liabilities and long-term investments. So here's the thing. The 2016 reported results are already in a present value, and those are the numbers that we're going to use. So cash is worth cash. So again, for TFI, excess cash in 2016 would be G9, and G10 and G11 would be the non-operating assets and the long-term investments. And again, let's get rid of some decimal places, make these comma. And for formatting, and this is the non-operating values. And they're already in a present value, so we'll assume non-operating assets, any new ones, NPV 0 in the future. Long-term investments, any new ones, NPV 0 in the future. This is the present value today. This is the value of cash, so that our non-operating value is the sum of these three things. Now, here's the thing. Excess cash is cash, that we're pretty certain about that value. Non-operating assets, we don't really know what they are. If we did, we might try and get a market value, but at least assume that the accountants would have written it down if it wasn't worth anything. They're probably not going to write it up, so we're probably in the ballpark of the value of those. The tricky part of these long-term investments. if I invest in another company, I'm a minority owner, then the thing is, I list it as book value. If the value of that investment appreciates, I don't put that market value on my balance sheet. I only list the book value. Now, if the value goes down, I can impair it, I can write it off, but I can't write it up. So we know that the long-term investments are probably a floor, but they're not a ceiling. So here's what we're going to do. We're going to go to an assumptions, and we're going to put in, I'll keep an extra row here. We're going to call this the price to book multiple for long-term investments. And we're initially going to start it at 1 as a placeholder. And a couple decimal places. I'll make this yellow. And I'm going to go back to my enterprise DCF, and I'm going to take the long-term investments, and I'm going to multiply it by, from the assumptions, this price to book multiple. So here's the deal. Let's say we own a company and it's worth 4 times what we paid for it. Well, I come here to assumptions, I change the price to book multiple to 4, and voila, it adjusts the non-operating value of our long-term assets. So we'll use the multiple as a way of doing it. As a placeholder, we'll at least start it out as a 1, which is a book value, but we give ourselves the ability to adjust this in the future. So back to enterprise DCF. Enterprise value is the operating value plus the non-operating value. And that is our forecast for enterprise value, or EV, 97,544. Now, enterprise value also equals debt plus equity, our 3s and our 4s. So here's again where our model can help us. Basically, to get to a share price, we pay off all of the debt and all of the non-common equity, and what we're left with is the value for the common shareholders. So that's where TFI helps us again. So equals, from our TFI, the current outstanding balance, so in this case 2016 reported, and we can see retirement-related liabilities, so that is G14. Oh, sorry, I'll label this, equals retirement-related liabilities, equals interest-bearing debt, equals we got to pay off the preferred shareholders, and we got to pay off the minority interest in the minority shareholders. And once those 4 stakeholders are paid off, whatever's left will be the common equity value of the firm. So retirement-related liabilities, TFI, 2016, which is G14. Debt is TFI G15. Preferred shareholders are owed G off of TFI 17. And minority interest shareholders are owed off of TFI 2016 as G18. So if we take our enterprise value and we subtract the sum of these 4 items, what we're left with is a forecasted common equity value. So if I divide that by shares outstanding, then I get my forecasted share price. So for shares outstanding, I'm going to make that an assumption. So copy and paste this here. And I'm going to make that yellow. And we need to get the current share count. The easiest way to do this is in Bloomberg. It's what's called the DES screen. For description, has some handy features. And I'll open it because I have a screenshot available. And on the DES screen, beyond the current share price, you see it up here, on the left, bottom left, they have the current shares outstanding. So 3,072.4 million, 3072.4. So 3072.4. Now again, the reason why I'm putting it on this screen, not On the other screen is that, again, we want to minimize the assumptions so we can change them and we don't have to go looking through the model. So I'm going to make this a reference to that, equals, from assumptions, refer to that current share count, and share price equals that divided by that. So again, the two decimal places, 1512. So here's the point. If all of the assumptions in the model come true, remember we just baseline some assumptions based on what's happening with the 2016 ratios, we end up with a 1512 share price. And what we're going to eventually try and do, the next step to get to the as-is model, is we want to basically go over here to the DES screen. Where did I put it? Where it is. Too many icons. Go back to it. For Ericsson, we want to get close to the 4850, and that's in the as-is. But in terms of your assignment and what I need you to do for Ericsson, just so that we all now have our model, is I need you to get to this point with the 1512, right? And that is going to be key to make sure that you have the model, right? Now, we're going to save this as the model, okay? Now, I'm going to create another file, save as. Actually, we'll do the as-is in here. And we're going to do what's called an as-is valuation, which means we need to get very close to this share price. So here's how we're going to do it. So, number one, on the Assumptions tab, we need to make sure we have a current WACC. So right now, the second screen we're going to need is the Ericsson WACC. WACC is the Bloomberg screenshot. And here's where we can get a current estimate of a company's WACC. And for Ericsson, you can see it right here. It's actually 9.2% as of this weekend. So that's the number that we're going to use to get to that share price. So we use 9.2. So again, we'll come back to our model. And instead of the 77, we'll type in 9.2. Okay, obviously, that is going to lower the share price a little bit because we're now discounting it at a higher rate. So because we're going to keep jumping back and forth between these screens, I'm going to do something just to help myself. Number one, I'm over here. I'm just going to put in share price. Can't spell. Share price. And I'm just going to refer to the enterprise DCF share price so I don't have to keep jumping tabs. And then on the ratios tab, which is we're also going to do this, I'm going to do the same thing. So here is my forecasted share price. And again, equals a reference to the enterprise DCF forecasted share price. So as I change ratios, I can see the impact of share price. And again, I don't have to keep jumping back and forth on the tabs. And I'll make this a little bit bigger so it's easier to see. Okay, so here's the thing. I need to basically put in more realistic numbers. Now, what's going to matter? Well, what's going to matter after we put in the WACC, you can see here in light gray, hopefully this is showing up in the video, these are the three most important things to forecast. Revenue growth rate, EBITDA, and tax rate, right? That basically gets me the key elements of the cash flow from operations. Now, reinvestment is going to be handled, and this is where I told you we'd get a benefit by putting all of these balance sheet items as a percentage of sales, which most of these are operating items. So here's the point. As revenue grows, because all of these balance sheet items are a percentage of sales, the balance sheet grows, which means it calculates reinvestment automatically based on an assumed similar level of productivity. So instead of having to forecast the balance sheet, we can forecast on the income statement, and as long as the productivity of the firm stays about the same, then the growth or shrinkage of the balance sheet will be automatically adjusted because everything here is tied to sales. So that's the elegant part of tying everything to revenue. Now, at any point in time, if we felt that a company's productivity changes, then we can adjust any of these. So for example, they're going to carry different inventory levels, or they're going to have different receivable levels, or different PP&Es. We can always change it. But what you'll quickly find is most of the valuation, the 80-20 rule, it's actually more like a 90-10 rule, is these three numbers. And these are the ones that we have to get right. So what are the expected growth rates? What are the expected EBITDA margins? What is a reasonable tax rate for the firm going forward? So let's start with the tax rate. All right, straight up, easiest way to figure out the tax rate, ask the company themselves. If you're a sell-side analyst, you talk to the treasurer, you talk to the CFO, and you basically say, what is your tax rate? And they have a pretty good sense, and they'll generally tell you what they think it's going to be. Now, we don't have access to the Ericsson people, so we have a couple choices. We can go into Bloomberg, we can look at conference calls, we can look at transcripts, we can look at analyst reports, we can see what people's using. But for simplicity here, what I'm going to do is I'm just going to say I need something representative. And as you can see here, 2016 looks like an outlier. Nobody pays 53% taxes on an ongoing basis, and most of them were closer to 30 with the exception of 2012. So we got about 31, we got 29, we got 30, we got 31. So I'm just going to swag it and say probably close to 30%. Seems like a more realistic tax rate on an ongoing basis. So I'm going to use 30%. Now, second thing we need to do is we need to come up with a representative EBITDA and a revenue growth rate. So here's where we need to understand our industry, understand the EIC, understand the company, but here's where we can also leverage the sell-side analysts. So again, the third screen that will help us in our valuation is something called the EEO. So in Bloomberg, go to the company and type EEO, which stands for Earnings Estimate Overview. And these are the financial estimates for the sell-side analysts, try making it bigger, based on the current expectations on how the company is going to do in the future. They're forecasting revenue, they're forecasting EBITDA. So what I'm saying is that the sell-side analysts probably know more about what the company is going to do than we are. So since this is the real world, let's leverage that. Now over here, and you'll see this is pretty typical of Bloomberg, these are the number of analysts that are forecasting. And you'll see that in year one, a lot of analysts, year two, forward year two, a lot of analysts, forward year three, less analysts, forward year four, hardly anybody. Now, all these analysts actually have forecasts going into the out years, but generally what happens is every time you put yourself out there, it's tracked. And if you're wrong, then it looks bad for you. So what the analysts tend to do is the first 2 years are pretty heavily forecasted and pretty heavily available in the forecast. Years 3, 4, 5, etc., they forecast, but not all of them put it out there, and particularly you get to 4 and 5. So they become less forecasted publicly, not to say they don't have a forecast, but it's harder to use this as completely reliable data. But almost every company you see in Bloomberg is going to have the first 2 years pretty heavily forecasted by all the sell-siders. So that's the point. We're going to use the first two, which are probably the most important anyways, current estimates to help us with the valuation. So translation. We need in our model, I'll go here, on the income tab, we need 17 and 18 revenue and EBITDA to pretty much match the consensus. And we're going to change the ratios to do it. So how I'm going to do that is off the assumptions tab. So here's what we're going to do. We're going to use the forecasted revenue and the forecast EBITDA for, and again, equals last reported year plus 1 and another plus 1 for 2000. Microsoft equals that plus 1 for the next 2 forward years. And I'm going to make these yellow, and we're going to basically put in what we see on the earnings estimate, the EEO screen for the next 2 years, next 2 forward years. So in this case, go back to preview. So for 2017, revenue 203,353. So 203,353. For 2018, 196,698. 196,698. For forecasted EBITDA, 2017 consensus estimate 12,704. 12,704. And for 2018 Consensus estimate is 21,287. 21,287. Okay, so right now, these are based on the day we're doing this valuation, October 13th. Basically, these are the current analyst estimates for EBITDA and for revenue for Ericsson going forward, which means our EBITDA margin forecast equals forecasted EBITDA divided by revenue is 6% and 10.82. So here's the thing. For these ratios, instead of making these yellow, I'm going to get rid of the color. And I'm going to make 2017 EBIT forecast come directly from the consensus estimate, and the 2018 forecast come from the consensus estimate. So notice that that changes the share price, and we're now at $32.45. Same thing for revenue. So here I'm going to add, insert a row, and then I have my revenue growth rate. So again, making these yellow, or not yellow, because it's going to be calculated. No fill. Revenue growth rate is current year minus previous year divided by previous year. So equals, left paren, current year 2017 forecast, minus from the income tab 2016 actual revenue. So G3, right paren, divided by G3, 2016 revenue. So basically, that would be the revenue growth rate that the analysts are predicting. Okay? And same thing, equals for 2018, current year minus previous year, right paren, divided by previous year. So again, percentage, extra decimal place, they're expected to shrink about 8.65 and then 3.27%. So again, let's go back to the ratios tab, and I'm going to get rid of these cells. So instead of making them yellow, I'm going to equals from the assumptions, that revenue growth rate, and for 2018 equals from the assumptions, that revenue growth rate. And if I did everything right, then 203,353 should be 203,353. 196,698 should match 196,698. And then 21,287 should be matching the EBITDA in our model. So basically, we're using the consensus estimates for the next 2 years to get what the analysts actually think, which gets us to a forecast share price of $37.34. Now, here's what I mean by an as-is valuation. The current share price, you can see this on the DES screen, for Ericsson is $48.50. So now we have to make an assumption of how do we get to $48.50 and get very close, like within $1 or a euro. And that's what's called an as-is valuation. So we know what these margins are, and for the next 2 years we know what the growth rates are, and then we have to think about the future. Now, in later classes, I'm going to give you some additional tips and tricks to do this. But right now, what we're going to do is we're just going to kind of do, again, a swag estimate for purposes of finishing this model. So one thing is, what is a reasonable EBITDA margin and what is a reasonable growth rate? And how do I change these? I don't think that Ericsson, as we go to 5G, is going to continue to shrink forever. And so this is where, for example, an IBIS World report giving us industry growth rate could be helpful, which is in low single digits. So let's assume they start eventually growing with the industry, and we'll put it at about 2%. Okay, so, or we'll call it 3%. And you'll notice that that's now a 42 share price, 41.92. And again, on the model, we're trying to get to 48.50. We also notice that for EBITDA, their margins were closer to 12 or 13, and now they get back to 11. Assuming that they are in that cycle, what if they got back to 12? Now we're at 48.41, which is 9 cents of their current share price, whatever it is. And actually, this is SEK. Thought it was euros. But the point is, we're now really close. And this is what's called the as-is valuation. So again, later we'll talk about tips and tricks to refine this. But for now, these are the changes that I want us to make. And then the final change is, do we think about CVG? 2%. Well, again, long-term 2% probably seems reasonable given the industry. We have some tools later to more refine this, but right now for setting the model, this feels reasonable. 2% perpetuity growth. We got growth rate going to very low single digits, about 3% for the next 5 or 6 years. And then we see margins, which are in a trough, start to go back to a little bit below they were normal. That's about what the market's thinking for the current share price. So this is going to be our, I'll save this, and I will call this save as, the as-is valuation, which means it's a forecast of reasonable assumptions for cash flows that get us very close to the share price. If you've gotten to this point, you've completed part of the next homework assignment to get the as-is valuation for Ericsson. Now we have finished our valuation model, and we've completed a reusable model which we will value for other companies. Save it, upload the file, complete the assignment. Now, for your next assignment, you're going to be doing a valuation of Costco. So we have the Ericsson as is. I need to do the same thing for Costco. So in the assignment folder, and I have it on my computer, I have the same 3 screenshots. So you have a roadmap on this video for the data you need to change. DES, you're going to need a current share price. So we're all going to do it based on this share price of 159.85 as of October 13th. We're going to do the current shares outstanding, 437.2 million as of the time of the valuation. We're going to use the WACC, which was 8.7, and we're going to use the EEO for Costco 2018, 2019. By the way, they just reported fiscal 2017. So the final thing that you're going to need is you're going to need to have the model data from Bloomberg. So this is the model template of the exported data from Costco with all of the zeros removed, or all the dashes removed and replaced by zeros. So here is how you reuse and replace the model template. And this is going to be important for your evaluation. Let's do a quick example here. So we're going to take the Ericsson model, and what I'm going to do, save my Ericsson as is, file, save as, and I'm going to rename this the Costco model as is. And I'm going to start to overwrite data. So the first thing I need to do is I need to overwrite the historical data of Ericsson, cell for cell, exactly mapped with the Costco data. So with the Costco data, with zeros replacing all the dashes, select the tab, copy it, go to the valuation model, select the whole tab, right-click, paste special values. Don't paste special values because you don't want to make links across spreadsheets. And that will overwrite the Costco data over the Ericsson data. Next, go to assumptions. What assumptions do we have to adjust? Well, the first one is that Costco has a September 3rd fiscal year. They're not December 31st, so they're already in to fiscal 2018. So they've reported 2017. So we need to change this to 2017. Second, they have a different WACC. So going back to the WACC, we go to Costco's WACC, and we need to put in their WACC. Next, we need to change the share count for Costco. So we need to match the share count for Costco. There it is. I'm not going to do all this. And then finally, we need to open up the EEO file, and we need, a little bit bigger, we need the revenue for 18 and 19 and the EBITDA forecast for 18 and 19 here to be overwritten. All right? Once we've done that, we need to go back here and adjust to get within $1 of their current share price, which again, as of the time of this video for Friday the 13th, which is the last reported date I had, we're trying to get to a dollar of $1.5985. So basically between $1.59 and $1.60.61. So long story short, that's your assignment. And a couple of things that matter. Number one, remember we have hard-coded in these growth rates for Ericsson, which we probably don't want to necessarily use those for Costco. So one of the things I can do is I can equal the previous year, and I can do the same thing with the EBITDA margin, and I can do the same thing with the tax rate. Now notice Costco's tax rate is higher than 30%, but it's been pretty consistent. So I can either use the last year, I could do a sum of the last 6 years and average them, or an average of the last 6 years. So the point is, this is where you have to get very close so that this share price is within $1 of their current share price with reasonable assumptions put in. Reasonable assumptions, growth rate, EBITDA, tax rate, and G. And basically submit that file, and then that's the next one that we're going to be discussing in class. That is your homework assignment. Good luck. And this is now the model we're going to continue using and refining, but nonetheless, the basic model to do an enterprise DCF, tied to Bloomberg, which is reusable for just about any manufacturing service company. Good luck.